We often imagine that when we hand our money to a bank, it is tucked away inside a reinforced steel vault for safekeeping. But as the door swings open, we find the room is completely empty. A bank functions as a financial matchmaker. It connects those who have capital with those who need it, moving money through the economy rather than guarding it in place. In fractional reserve banking, deposit $1,000 and the bank keeps only a small fraction. They lend the other $900 to someone else, charging them high interest while paying you almost nothing. They collect significant interest. Your balance stays stagnant. The money you believe is safely stored is actually out working to build the bank's balance sheet. By keeping your cash in a standard savings account, you are providing the fuel for someone else's growth, while your own wealth remains frozen. This system relies entirely on our shared belief in the value of currency. A dollar bill has power only because we agree it does. Without societal trust, it holds no more legitimacy than a stick in the woods. Because currency is a social construct, it is subject to inflation. This is a slow erosion of purchasing power that happens gradually over years, rather than in a single visible event. As the top line shows, supply chain issues and shifts in consumer expectations drive the cost of goods higher. Consequently, the bottom line shows your $5 bill buying less gas and fewer groceries than it did a decade ago. When inflation spikes, wages often fail to keep pace. Central banks may raise interest rates to cool the economy, but for those with dormant savings, the value of that cash continues to decline. Leaving money in a bank account results in a steady loss of real-world value. As prices rise, the purchasing power of your stagnant dollars is quietly struck away. To protect your future value, your money must transition from sitting idle to actively working. This requires moving away from trading your hours for a paycheck and toward trading your capital for more capital. Most investors use diversified funds to achieve this. These are collections of stocks and bonds that allow you to participate in the market without the risks associated with picking individual companies. By owning these funds, you hold tiny slices of global corporate growth, ensuring that your wealth is tied to the productivity of the broader economy. The engine behind this growth is compound interest, a force that turns small, consistent gains into significant wealth over time. Simple interest is a flat fee. Compound interest lets dollars create clones that earn rent, duplicating your investment. On the left, high-interest credit card debt turns small mistakes into a financial fire. On the right, it turns small investments into a seven-figure portfolio. Wealth is built by deploying capital into these diversified engines and allowing the process of duplication to run its course. Capturing this growth begins with creating value. High earners, such as innovative entrepreneurs, generate wealth by providing significant utility to society. When someone creates a technology that millions of people find useful, they receive capital in exchange for that perceived value. Once that value is converted into an investment, the primary factor in its growth is time. Wealth is built over decades. Gains that appear small in the first few years multiply at an accelerating rate the longer they are left to sit. Ordinary people retire with substantial wealth by utilizing this system. They invest consistently and allow time to act as their most effective employee. If you're ready to start your own journey, hit the like button and tell us in the comments what you're investing in. Subscribe to Asset Rise for more blueprints on building your future.